On Friday, January 30th, 2026, President Trump officially nominated Kevin Warsh to succeed Jerome Powell as Federal Reserve Chair. 48 hours later, $5 trillion vanished from global markets. Gold and silver hit the lower circuit on the MCX, dropping 9% in a single session. Bitcoin tumbled 8%. Equity markets bled red across every time zone. Most investors are calling this profit-taking. They believe a Trump-appointed Fed chair means lower rates and higher asset prices. You see, that's the trap. Warsh isn't here to print money. He's here to extract liquidity. He's an advocate for what he calls regime change and a rapidly shrinking balance sheet, which means the $5 trillion wipeout wasn't a panic. It was the opening move. Today, I'm breaking down the three mechanisms that triggered this liquidation, why the crash was mathematically designed, and why the 2026 maturity wall just became your timeline. A mandatory protocol before we open the file. This is not financial advice. I'm not a licensed advisor. The math follows a script, but your capital is your responsibility. Always conduct your own research. Let's start with the mechanism the financial media ignored. The crash didn't begin with fear. It began with a margin hike. On Friday, January 30th, 2026, the exact same day Trump announced the Warsh nomination, the CME Group raised margin requirements on COMEX gold and silver futures, not by 2%, not by 5%, by enough to force leverage traders into immediate liquidation. You see, most retail investors don't understand how the futures market works. When you buy a gold or silver futures contract, you're not putting up the full value of the metal. You're putting up a fraction called margin. The CME sets that margin percentage, and when they raise it, traders who are using leverage suddenly don't have enough capital to hold their positions, which means they're forced to sell, not because they wanted to, not because the fundamentals changed, because the exchange mechanically pulled the rug. Plus, this wasn't announced in advance. The margin hike went live within hours of the Warsh news breaking. And the result? Sunday, February 1st, 2026. Gold futures opened and immediately fell 9%. Silver collapsed even harder. The MCX triggered lower circuit breakers, a safety mechanism that halts trading when an asset drops too fast. But here's the forensic detail most people missed: the volume. Trading volume on gold and silver futures that weekend was the highest it had been since March of 2020. Higher than the Silicon Valley Bank collapse, higher than the regional banking crisis. This wasn't organic selling. This was forced liquidation at industrial scale. You see, when margin requirements go up, the biggest players aren't the ones who get hurt. They have the capital reserves to meet the new requirements. It's the leveraged retail traders. They were the collateral. The CME knew exactly what they were doing. Warsh's nomination was the headline. The margin hike was the execution, which means this wasn't a market reacting to news. It was a market being recoded in real time. Now, if this mechanism just clicked for you, or you want to track these shifts as they unfold through 2026, join the Forensic Circle by hitting subscribe. The maturity wall doesn't wait for anyone. Let's move to the deep dive, because the margin spike was just the surface. The real story is what Warsh said 3 years ago about the printing press, and why $5 trillion was only the entry fee for what he's about to do to the balance sheet. Here's what most analysts are missing. Kevin Warsh didn't just criticize Jerome Powell's policies, he wrote the blueprint for dismantling them. In a series of op-eds and speeches between 2022 and 2024, Warsh laid out what he calls regime change at the Federal Reserve. Not a policy tweak, not a rate adjustment, a complete reversal of the Fed's operating philosophy. You see, since the 2008 financial crisis, the Federal Reserve has operated under an unspoken contract. When markets fall, the Fed steps in, lower rates, expand the balance sheet, print liquidity. Wall Street called it the Fed put. It meant you could take risk, because the Fed would always catch you. On January 30th, 2026, that contract was torn up. Let's go to the exact language Warsh used. In a 2023 essay titled "The Fed's Mission Creep," Warsh wrote, "The central bank has become the lender of first resort, the buyer of last resort, and the guarantor of asset prices. This is not monetary policy. This is financial socialism." Financial socialism, which means, in Warsh's view, the Fed isn't supposed to protect your portfolio. It's supposed to protect the currency. Plus, he went further. In a 2024 speech at Stanford, Warsh stated, "If the printing press could be quiet, we could have lower policy rates." Read that again. He's saying the Fed can only cut rates if it stops expanding the balance sheet, which means if you want lower borrowing costs, you have to accept the destruction of the asset bubbles that QE created. The math is binary. You can't have both. Now, let's apply this to what happened on February 1st, 2026. The $5 trillion wipeout wasn't random volatility. It was the market pricing and the death of the Fed put. Here's the breakdown. Gold ETFs fell 13% in 48 hours. The SPDR Gold Shares ETF, ticker GLD, dropped from $193 to $168 per share. Silver ETFs collapsed 20%. The iShares Silver Trust, ticker SLV, plunged from $26 to $20.80. Bitcoin tumbled 8%, barely holding the $77,000 level. Equity markets bled across the board. The S&P 500 lost 4.2%. The Nasdaq dropped 6.1%. Total global market capitalization erased in precious metals, crypto, and equities, $5 trillion. You see, this wasn't profit-taking. Profit-taking is gradual. This was a liquidation event, which means traders weren't selling because they wanted to lock in gains. They were selling because they realized the game had changed. Here's the mechanism. Under Powell, the Fed operated on what they called data-driven policy. That's code for reactive. Wait for inflation. Wait for unemployment. Wait for a crisis. Then respond. Warsh is proposing the opposite. He calls it forward-looking regime change, which means the Fed doesn't wait for the data to confirm a problem. It moves preemptively to reshape expectations. This is straight out of the Paul Volcker playbook from 1979. Volcker didn't wait for inflation to stabilize. He broke it. He raised rates to 20%, triggered a recession, and destroyed the speculative bubbles of the 1970s. The economy screamed, unemployment spiked, asset prices collapsed, but the dollar survived. Warsh is betting the same trade will work in 2026. Let's go deeper into the balance sheet mechanism. Right now, the Federal Reserve's balance sheet sits at approximately $7.2 trillion. That's money the Fed created out of thin air to buy treasury bonds and mortgage-backed securities during the COVID crisis and the regional banking panic of 2023. Warsh has called this mission creep. He wants to shrink it. But here's the trap. When the Fed's balance sheet shrinks, liquidity leaves the system, which means there's less money chasing the same assets, which means asset prices fall. Plus, the Fed has been the largest buyer of U.S. Treasury debt for over a decade. If the Fed stops buying, someone else has to step in. That someone is the private sector. Pension funds, insurance companies, foreign central banks, retail investors. But here's the problem. The private sector demands a higher yield than the Fed does, which means interest rates go up, even if the Fed cuts the policy rate. You see, this is the paradox Warsh is engineering. He can cut the Fed funds rate to 3% or 2.5%. But if the 10-year Treasury yield is climbing because the private sector won't buy bonds at current prices, your mortgage rate doesn't go down. Your corporate borrowing costs don't go down. The rate cut becomes irrelevant. Now let's frame this for your capital. If you were holding gold, silver, or Bitcoin because you believed Trump's Fed would print money and debase the dollar, you just learned the hard way that the script flipped. Warsh isn't printing, he's extracting. Which means the assets that performed well under Powell's liquidity injections are now the first targets for liquidation under Warsh's balance sheet contraction. Gold fell 13%, silver fell 20%, Bitcoin fell 8%, and that was just the opening trade. You see, the $5 trillion wipeout wasn't the climax, it was the entry fee. The real liquidation begins when Warsh takes office and starts quantitative tightening at scale. Here's the timeline. Warsh's confirmation hearings are scheduled for late March 2026. If confirmed, he takes the chair in May, which means you have approximately 90 days before the balance sheet reduction accelerates. Plus, the 2026 maturity wall is already here. Over $4 trillion in commercial real estate loans, corporate debt, and treasury securities are maturing between now and December. That debt needs to be refinanced. But if the Fed is shrinking its balance sheet instead of expanding it, where does the liquidity come from? The answer, it doesn't, which means defaults, bankruptcies, forced asset sales. The same cycle that destroyed the Hunt brothers in 1980, the same cycle that broke the British pound in 1992, the same cycle that collapsed long-term capital management in 1998. Warsh knows this. Trump knows this. They're counting on it. Because the goal isn't to save your portfolio. The goal is to save the dollar's reserve currency status by proving the Fed can still enforce discipline. The $5 trillion wipeout was the market's first lesson. The real exam starts in May. But even this doesn't explain why Warsh was chosen now, because there's a pattern here. A script that has played out 3 times in the last century, and the US just entered stage 5. History doesn't repeat. It rhymes. And the rhyme scheme for 2026 was written in 1980. You see, what happened on February 1st wasn't new. It was a rerun. The script has a name, the Volcker Reset. Let me show you the pattern. 1979, inflation is running at 13%. The dollar is collapsing against gold. OPEC is pricing oil in Deutsche Marks because they don't trust U.S. currency. President Carter nominates Paul Volcker to chair the Federal Reserve. Wall Street celebrates. They expect Volcker to cut rates and restart the printing press. Instead, Volcker raises rates to 20%. The stock market crashes. Unemployment spikes to 10.8%. The economy enters a brutal recession. But the dollar survives. You see, Volcker understood something the markets didn't. The Fed's credibility was worth more than the S&P 500, which means he was willing to destroy asset prices to save the currency. Warsh is running the same playbook. Now let's overlay the math. In 1979, inflation was at 13% when Volcker took office. In 2026, inflation is hovering near 3% when Warsh is nominated. The common belief says this is different. Lower inflation means no need for extreme measures. But here's what the data shows. Volcker didn't wait for inflation to peak. He moved preemptively. By the time he raised rates to 20%, inflation was already falling. Which means the rate hikes weren't about fighting current inflation. They were about resetting expectations for the next decade. Warsh is doing the same thing. The $5 trillion liquidation wasn't about current inflation. It was about killing the expectation that the Fed will always print. Here's the second parallel. 1980, the Hunt brothers. Nelson Bunker Hunt and William Herbert Hunt were two Texas billionaires who tried to corner the silver market. They borrowed billions to buy physical silver and silver futures contracts. By January of 1980, they controlled over half of the world's deliverable silver supply. The price of silver went parabolic, from $6 per ounce in 1979 to $50 per ounce by January of 1980. Then, the exchange changed the rules. The COMEX raised margin requirements. The New York Mercantile Exchange banned new long positions in silver futures. The Hunts couldn't meet the margin calls. Silver collapsed from $50 to $10 in 8 weeks. The Hunt brothers were wiped out. Plus, the trading volume during that collapse was the highest in COMEX history up to that point. Sound familiar? Now let's connect this to February 1st, 2026. Silver had been climbing steadily since November of 2025, from $22 per ounce to $32 per ounce. Gold hit $2,700. Record inflows into precious metals ETFs, retail investors piling in on the narrative that Trump's Fed would debase the dollar. Then, Warsh is nominated. The CME raises margin requirements. Silver collapses 20% in 48 hours. The trading volume on precious metals futures that weekend was the highest since March of 2020. You see, this wasn't organic profit-taking. It was a controlled demolition using the exact same mechanism that destroyed the Hunt brothers 46 years earlier. The playbook hasn't changed. The only difference is scale. Now let's zoom out to the imperial pattern. According to the 7-stage collapse model, the United States is currently in stage 5. Stage 5 is defined by currency volatility and liquidity extraction. Let me walk you through the stages. Stage 1, reserve currency dominance, the Bretton Woods Agreement of 1944. Stage 2, overextension, Vietnam War spending and Great Society programs in the 1960s. Stage 3, currency detachment. Nixon closes the gold window in 1971. Stage 4, financialization. The shift from manufacturing to debt-based growth, 1980s through 2008. Stage 5, currency volatility and liquidity extraction. That's now, which means the system is attempting to restore credibility by forcing deleveraging. Warsh's balance sheet reduction is the mechanism. The $5 trillion wipeout is the collateral damage. Here's why this matters for your timeline. Stage 5 doesn't last forever. Historically, it lasts between 18 months and 4 years. The Spanish Empire entered Stage 5 in 1598 when they defaulted on debt to German bankers. They reached Stage 6 by 1607. The British Empire entered Stage 5 in 1914 when they suspended gold convertibility to fund World War I. They reached Stage 6 by 1945. The Soviet Union entered Stage 5 in 1985 with Gorbachev's reforms. They reached Stage 6 by 1991. The math doesn't care about exceptionalism. You see, Stage 5 always ends the same way. Either the system successfully deleverages and restores credibility, which requires destroying enough wealth to scare the population into accepting austerity, or the system fails to deleverage, and Stage 6 begins. Stage 6 is hyperinflation or sovereign default. Now let's bring this to the 2026 maturity wall. Between now and December of 2026, over $4 trillion in debt is maturing. Commercial real estate loans, corporate bonds, treasury securities. Under Powell's Fed, that debt could be rolled over at low rates because the Fed was buying. Under Warsh's Fed, the balance sheet is shrinking, which means the private sector has to finance the rollover. But the private sector won't buy $4 trillion in new debt at 3% yields. They'll demand 4%, 5%, maybe 6%, which means borrowing costs spike, even if the Fed cuts the policy rate. Plus, higher borrowing costs mean more defaults. More defaults mean more forced asset sales. More forced asset sales mean lower collateral values. Lower collateral values mean bank losses. Bank losses mean credit contraction. This is the liquidity death spiral. It's the same mechanism that triggered the October FOMC warning about a disorderly fall in asset prices. You see, the Fed knew this was coming. They wrote it down in the minutes. They warned that a rapid withdrawal of liquidity could cause funding stress and market dysfunction. That was October of 2025. Warsh was nominated in January of 2026. The $5 trillion liquidation happened 48 hours later. The maturity wall hits in stages between now and December. Here's the cold math. If Warsh successfully shrinks the balance sheet and forces deleveraging, the US stays in stage 5 and avoids hyperinflation. But the cost is a deflationary crash that wipes out trillions more in asset values. If Warsh fails, and the private sector refuses to finance the debt rollover, the Fed is forced to reverse course and print, which means stage 6. Either way, your 2026 timeline just compressed. The Volcker playbook worked in 1980 because the US still had manufacturing capacity and a positive trade balance. The question is whether it works in 2026, when the US runs a trade deficit of nearly $1 trillion per year and the economy is 70% financialized. The answer determines whether this is a controlled reset or the beginning of stage 6, which brings us to the final question. What do you do with this data? Because the script is written, but your capital doesn't have to follow it. Most people will watch this liquidation unfold and call it a crash. They'll blame Trump. They'll blame Warsh. They'll blame volatility. But if you've made it this far, you're not most people. You see the fingerprints. You recognize the pattern. You understand that the $5 trillion wipeout wasn't chaos. It was the entry fee for the new regime. You see, the architects don't break systems. They recode them. And 2026 is the year the code gets rewritten. The maturity wall, the balance sheet contraction, the BRICS gold-backed currency launch scheduled for August. These aren't isolated events. They're coordinated pressure points designed to force a reset, which means the next 9 months will separate those who understand the script from those who become collateral in it. Now, if you refuse to be a victim of this timeline, if you're the type of person who holds yourself to a different standard, subscribe to the Forensic Circle. Because I'm currently writing a full autopsy on the budget 2026 import duty trap and how it connects directly to the Warsh liquidity extraction. That breakdown drops next week. Make sure you're subscribed so you don't miss the reveal. Here's the summary. January 30th, 2026. Warsh is nominated. February 1st, 2026. $5 trillion is erased. The CME margin hike wasn't random. The liquidation wasn't organic. The Fed put is dead. Warsh isn't here to save your portfolio. He's here to save the dollar by extracting liquidity and forcing deleveraging. The Volcker playbook from 1980 is running again in 2026. Stage 5 of the imperial collapse pattern is in motion. And the maturity wall doesn't wait for anyone. The system isn't breaking. It's being recoded by the architects. And you just read the manual.